matters here. I only have one slide, 1.5, so kind of I listen to briefs, you know. And I also need to say that the previous two speakers was perfect segue into my thing, because it's difficult raising capital for entrepreneurs in South Africa. You're too developed, and you're also not kind of like you know, the DFIs don't get brownie points for getting us money here, but we managed to get there. So at one point we were listed. So I do agree with Arnold, you should not be listed. What sucks even more than because you're chasing quarterly targets for share price, you don't actually chase long-term businesses like most of us in this room. The market does not understand it, so it forces you into a consulting model because every quarter matters. What sucks even more than being listed is buying your own company back out of being listed. So you know, Evan and Andrea and I have a real war story to tell about that. That really hurts. Anyway, that's done and dusted. I think Zach's a better VC than I am. I think he's probably talking about unrealized IRR, but our fund one realized IRR was 59%. And in that fund, we exited the company to General Electric, one to Visa, and one to Uber Eats, all South African companies. So remember, you said 60. So one day when I grow up, I want to beat 59. And also he talked quite a bit about rule of 40s and all the rest of it. But yeah, I do have slides. Must I press something, or can you guys put it up? So this is my one slide. And what I'm talking about is, we all know that we are in a tough environment. You know, anyone who's running a business know your clients are taking longer to pay you. They are taking longer to convert the POC into real revenue. There's always a bit of an excuse. Your team salaries are getting cut a little bit. It's December coming up. We're all stressed about bonuses because none of us can pay it. It's just a cash flow crunch. So if you are a high growth business, and it's not just for raising capital, what matters at the moment? So I've got 10 of the top things that matters in a down market. So it's difficult to exit, it's difficult to raise, unless you have capital efficiency. So what happens in this market, and you listen to the drone example, is companies that raise capital and don't turn that capital into revenue are at a disadvantage when the tide goes out. So it's fine to raise Series A, 10 million, another 20 million, we're growing and we're raising. But suddenly when those valuations go up, people will look and say, okay, listen, company X, you are now 5 or 6 years old, and you have raised $20 million, and your revenue is $2 million. So where did the $20 million go? And no, we've built this amazing tech. We're just about to kind of go like, wow. So you built tech that no one's buying. So you didn't invest in your marketing team and all the rest of it. And it's not because the VCs worry about this. It's because the M&A team of the acquirer that we're selling these companies to eventually, because we talked about don't list, also there's no IPOs really happening of tech businesses here. So basically, there's a lot of M&A activity, and I can give you a good presentation on that. But companies strategically grow through two ways, organically, but in a down market, they actually grow through acquisition. They say, shit, you know, our innovation teams are not as clever as these startups, let's buy. And when that M&A team looks at your data room, they look at what have you done with the money that you have raised from the beginning to now, and they divide that number by your revenue, and you get a capital efficiency ratio. Go Google it. If it's less than 1, it's amazing. So you've raised 10 million and your revenue is 11 million. That's amazing. If it's over 5, you've raised 50 and your revenue is 10, then you're in trouble. The stage matters, because obviously in your first year or two, you're going to obviously raise more money than what your revenue is. But just, you know, be capital efficient. That helps not just for raising capital, but it helps for building great businesses. Rule of 40. If you heard it when Zach said it the first time, it's basically just your revenue growth rate and your EBITDA margin. So if you're growing at 50% year on year, I don't care. You don't have to be profitable. You can actually burn 10% on EBITDA. But if you are starting to pull back on growth, let's say you've only grown 17 or 20% year on year last year, well then you better have like 20% of EBITDA because of a slower, it's just a life cycle 101 of a company. You know, if it's high growth, please don't make money. Take that money and shove it back into sales and growth until you run out of growth. Well, then you need to make sure that you kind of deliver other shareholder value to businesses, which is so basically. Revenue growth plus EBITDA margin needs to be more than 40%, because then you're bucking the trend, and then can you have higher multiples on valuation, all the rest of it. path to positive unit economics, that CAC and NAC and LTV and all that stuff that Vac was talking about, that's what I'm talking about. So positive unit economics, or a path towards, it's the numbers behind, it's the Excel sheet behind the Excel sheet, which is your financial model. So revenue is not your first line on Excel. Revenue pulls in from another sheet, which has widgets times money per widget, times 2 revenue streams, times a bit of consulting on the side because you have to pay the bills, and all of those things, but it's that. So you have to have positive unit economics, because if the sausage machine is working, throw more meat in. Like it's just basically repeat, rinse and repeat. You found that repeatable, scalable business model, and then it's easier to raise funding. When you're still tweaking with the business model and you're making losses there, then it's difficult. Valuation matters. So a lot of, not so much South African entrepreneurs, I do actually pride ourselves. When we see business plans here, it's generally much more humble. The companies build real companies. They have a sensible valuation, and it's not about out-negotiating a startup. It's just, if I invest in a company at a too high a valuation, then I need to exit that business at a 5x, 10x, and I usually have a veto. So basically, I'm too embarrassed as a VC to tell my LPs I've lost money in a down round, so basically just never sell. So that's why we have all these paper unicorns in Africa and not realized unicorns, because they're too overvalued, so no one's buying them for that value, because the M&A team and the potential acquirer is clever. They are clever oaks. I shit myself for those oaks. And they look at these things. Anyway, so realistic exit expectations. Yeah, our favorite unicorns there. We're not unambitious. We definitely have unicorns. But what can you really exit for? If everyone's going to build a unicorn, no. I mean, Knife Capital built a whole business on exiting businesses between $12 million and $110 million. And I'm quite happy as long as you invest 2 and 6 times money to 12, or you invest 20 and you make 100 and 100. So you just churn capital into the system back to investors. So have realistic expectations of an exit is a whole different topic on its own. But basically, every journey ends. Trust me. And at some point, and if you build a disruptive, kick-ass business that ask pitch payments, that actually take someone else's, disrupt some industries, people are going to get interested. They're going to want to invest, or they're going to want to acquire you. My house is not for sale, but at some point, if someone rings the doorbell and give me enough money, the kids are packing their bags and we're leaving. A team that can execute. So a team is obviously, back the jockey, not the horse cliche. But it's not about what the jockey has done. It is what the jockey is doing around capital efficiency, unit economics, and all the rest of it. And it's basically just jockey or jockeys. Execution. Large market, kick-ass product, execution, ability of a kick-ass product into a large market, rinse and repeat. So one has to show, Zach talked about momentum and about traction. One has to show execution ability, because next year's Excel model looks quite scary, and year 2, and year 3, and year 5, that hockey stick goes through the valley of death into craziness. We have to believe that you can do it. And why do we believe it? Because you've done it sort of with your unit economics to a smaller scale. Give me more money, I can. Durable customer base. Is there churn? Do they kind of leave you? Do they stick? Is your model a SaaS sort of repeatable model, or is it sort of every month you wake up, you have to start on the first of the month selling again? Or is it kind of a recurring business, revenue business like Akasha's business over there, or a few others that I know here? Basically, you can kind of bank your last month's revenue and grow from there. Product differentiation. Do you have a moat around that is difficult for someone else to just throw more money at it and go for it? So what differentiates you? What is the product market fit? And differentiated businesses that have little burn, so burn is basically how much money you're burning on a monthly basis. How much runway do you have left? Is it 6 months? Is it, when we get businesses as VCs of companies coming in and say, listen, I have to get the money before the end of December, otherwise, the business runs out of money and we have to shut down. I say, well, it's difficult for me to enter into due diligence, legal, all the rest of it, and give you the money, and I want to go on holiday on the 15th, so good luck. But if you had to come to us and sort of have 6 months runway, 12 months runway, how does that runway and burn multiples and stuff work? And then my pet project, the acquirability index. So, and whether you are a VC or not, businesses generally that disrupt stuff is going to get acquired or partner with or do sales channels with others. And how acquirable are you? Every journey ends. Do you have data room stuff? Is your value proposition clear? Can you explain your business in 4 words? Google, easily find useful information. Facebook, connect with your friends. Life Capital, exit-centric business building. So, you need to be able to do that, otherwise you're not clear enough. So yeah, that's that, actually. Hey, wait, I want to show you one slide. Can you put the next slide on? So this was a SaaS conference where they basically, it's a bit deceiving because it's not the most important things, it's what's most important versus how important it was last year for investors in Silicon Valley. Small sample base, but if you look, capital efficiency, most, top of that. Valuation, the right valuation. Convincing AI strategy, which is obviously convincing. Everyone does AI. I wrote my daughter a letter because she's on a quest somewhere, and I just said, write a letter to a daughter, which is sort of solo quest in Cedarburg, and tell her how proud I am, and it's done. So she luckily has a sense of humor, but, Anyway, and then the competition and quality of teams. So these things matter right now more than ever because the tide has gone out, and we need to survive. You need to survive because I want to fund you in better times. Or now, but now the valuations are down.